Our next guest, that's going to be George Tsilis, senior markets correspondent here. George, we're talking Netflix. This is one I kind of wanted to hit. It's up 40% so far this year, up 55% from year-ago levels. I mean, this should have been in the Magnificent Seven because it has been straight up over the last couple of years.
It has. I mean, this is a pretty remarkable turnaround, and I think I'm going to put another company in the same camp, Meta Platforms, because both of these companies, if you look at performance in the bear market, which really started back in November 2021, they declined significantly, and they've rebounded significantly since, of course, the correction now manifested through the end of 2022. So I think this is a great story for Netflix. If you look at price performance, it's really getting close to those $700 intraday highs going back to late 2021. It's been a steady mover. And overall, I think their business model has really successfully pivoted. And so they really have focused more so, and they talked about this even last quarter when they reported earnings, subscriber growth. They're not going to be reporting it going forward in the next year because of the composition of their revenue breakdown, which is now growing advertising. So these are advertising-based companies. I'm going to throw Meta Platform in that same camp. And that's where Netflix is going. And so I think the restructuring of their pricing plan, for the marginal viewer, essentially going to the advertising model. And then, of course, those who want to pay for the logins, they did pay. So they actually restructured all their pricing to, again, pacify those who are at the margin, not a very active viewer. That's been a good strategy. But at the same time, one thing about Netflix is doing is that subscriber ads, if you look at last quarter, grew 16%, sales were higher 15%. So when you see the subscriber growth faster than revenue growth, that's very positive. But one of the things I noticed, Netflix is less profitable than it has been in the past historically in terms of its growth rates, but its margins have expanded. And so I think what's happened here is the pricing restructuring has really impacted the bottom line, even though the growth rates for both sales and earnings are actually down compared to their 5-year averages. Their profit margins are higher by about 30%. At the same time, their multiple, if you look at the forward multiple, at least for 2025's 30 times earnings, it's trading around 38% discount to its 5-year average. So the company seems to be executing very well operationally, because if you look at the operating margin growth that the company's generated, it's about 45% compared to when I calculated it to late 2022 for the full year. So they've become more efficient. They've actually increased their margins slowly. And irrespective of the decline in sales growth, 11% is estimated for next year. And that's significantly lower than their 5-year average, which is around 17%. But effectively, the profit growth is also going to be around 24%, which is below their historical average. So all the averages on a historical basis are higher than its last year, but their profit margin has expanded. And I think it's an important story underneath Netflix because they really seem to be operating extremely well, irrespective of the slower growth rates.
Yeah, and I think that margin expansion due to this ad tier that came into fruition. As of mid-May, they had 40 million users on that, so that's probably helping widen out margins. George, my question to you is, though, when I look at the PE and the forward-looking PE, they're getting pretty thick here. Is that, a cause of concern as we're getting close to that all-time high of $700 a share?
So that's the thing. It's a good question. And again, like I brought up just a moment ago, if you look at the revenue growth rates, it's about 10% lower than its historical average. If you look at the earnings growth rates, it's around 12% lower than historical average. But the stock is trading at an earnings multiple about 30% lower than its historical average. So one could make the case that even though the profit growth rate and the revenue growth rate is decelerating, that it's still cheap on a historical basis. And I'm looking at 2025's forward multiple around 30 times compared to the 5-year average of 49. So I think this is a situation, Tom, ideally speaking, let the market tell us what's happening. Obviously, the trend in the last year has been higher. But I think that level, which is right around an intraday basis, $700, needs to be broken for potential trend continuation.
Yeah, they got earnings coming up. One more quick thing, George, you've got like 20 seconds, is subscribers, 270 million subscribers paying. But saturation here in the States, but is international enough to pull them, or to support maybe this high valuation that we've got?
So here's another thing. Yeah, it's a good question. If you actually look at what they've done on an international basis, they seem to have tapped into the price sensitivity of the international markets. They actually lower prices internationally. I think
Yeah.
that's been a great strategy because it just adds more users in the international market because they realize the saturation in the United States, but they still have tremendous opportunities internationally. And so they're essentially tapping into the willingness to pay for consumers here in the United States through the different price structures, ad tiers, and so forth, but also international sensitivity to prices. They've lowered them, and I think it's been a great move.
Yeah, they're taking a playbook out of the pharma companies, sticking it to us here in the U.S. by having higher rates.
Exactly.
Of course. All right, great stuff. Great backdrop for us. That's George Tsilis, Senior Markets Correspondent here, breaking down Netflix.